Two Alphabet Income ETFs walk into the examination room carrying headline yields above 30%. One has grown its net asset value while distributing $28.23 per share. The other has distributed $16.48 per share while its NAV fell 38%. Both still produced positive distribution-inclusive results. Both also carry the exact same assigned diagnosis: on life support. So this is not a simple story where one patient is healthy and the other is dead. It is a story about two very different machines built around the same company, two eye-catching weekly payouts, and two distribution streams that have weakened dramatically since their opening rounds. GOOW promises 2 times leveraged weekly exposure to Alphabet's price return. GOOY turns Alphabet's potential upside into option premium through a synthetic covered call strategy. One presses harder on the accelerator. The other rents out part of the accelerator for cash. Today, Income Autopsy is dissecting where those weekly payments came from, what happened to the capital underneath them, and why a positive total result does not automatically mean the income engine is in good condition. Our first fund is the Roundhill Google Weekly Pay ETF, ticker GOOW, launched by Roundhill on July 24, 2025. It has $91 million in assets under management, charges a 1% expense ratio, and sits in the trading, miscellaneous category. GOOW is not merely a conventional fund that buys Alphabet shares and mails out the dividends. Alphabet is the subject, but the fund's machinery is built primarily around a Google swap representing 99% of holdings. It also reports a United States Treasury bill position of 62% and a direct Alphabet position, ticker Google, of 21%. Those percentages can overlap because a derivative does not work like a fully paid stock position. The Treasury bills can serve as liquid collateral while the swap supplies economic exposure. Think of the swap as a contract that lets GOOW receive the movement of Alphabet without needing to build the entire exposure through ordinary shares. The target is 2 times Alphabet's weekly price return. If Alphabet has a strong week, GOOW is designed to capture amplified weekly movement before fees, financing effects, and tracking differences. If Alphabet has a bad week, that leverage can magnify the pain too. Because the target resets weekly, this is not a promise that GOOW will deliver exactly 2 times Alphabet over every longer holding period. The route matters. A smooth climb and a violent zigzag can reach similar destinations for the stock while producing different results in a resetting leveraged fund. GOOW then pairs that structure with weekly distributions. Crucially, the supplied fund description does not identify GOOW as a covered call fund and does not say it writes calls against Alphabet. Its defining mechanism is the leveraged swap exposure, supported by Treasury bills and a direct stock position, with an actively managed weekly distribution policy layered on top. That distinction matters. The distribution is not proof that Alphabet itself produced that much cash. Investors must inspect current fund documents to determine the composition of each payment and whether it came from income, gains, or return of capital. Across the table is the Yield Max Google Option Income Strategy ETF, ticker GOOY, launched by Yield Max on July 27, 2023. It is the older and larger fund, with $250 million in assets under management. Its expense ratio is 1%, and it belongs to the derivative income category. GOOY's reported holdings look strange if you expect a pile of Alphabet shares. United States Treasury bills at 119%, a 10% cash offset, First American Government Obligations Fund Class X, ticker FGXXX, at 3%, plus 3 call options the fund writes for premium income. That is the synthetic covered call machine. Cash and Treasury collateral support derivative positions that create exposure around Alphabet, while the written call options collect premiums. Selling a call is like accepting cash today in exchange for giving someone else a claim on gains above an agreed level. If Alphabet moves sideways or rises only moderately, that premium can be useful income. If Alphabet rockets upward, the calls can cap how much of that rally GOOY keeps. If Alphabet falls, the option premium provides only a cushion, not a force field. So the strategic split is sharp. GOOW seeks amplified weekly participation in Alphabet's price return and then makes weekly distributions. GOOY explicitly manufactures income by selling calls, accepting capped gains as the price of collecting premium. GOOW adds leverage and path dependency. GOOY monetizes volatility and surrenders some upside. They share the same corporate reference point, but they do not share the same engine. Owning either one is not economically identical to simply owning Alphabet. One reshapes the stock through leverage. The other reshapes it through an income-for-upside exchange. Before we open the payout records, this is educational research only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold GOOW, GOOY, Alphabet, or any other security. ETFs can lose value. Leveraged exposure, derivatives, option writing, weekly resets, fees, taxes, and distribution policies can all produce outcomes that differ substantially from the movement of the underlying stock. A distribution is not guaranteed, and a high quoted yield does not tell you whether the payment came from durable income, realized gains, unrealized economics, or a return of your own capital. Verify the current prospectus, holdings, distribution notices, tax documents, and other official fund materials for yourself. Fund strategies and portfolios can change. Consult a qualified financial, tax, or legal professional who understands your circumstances before making decisions. Now to the numbers most likely to attract attention. GOOW reports a 31% headline distribution yield and pays weekly. GOOY reports 34% and also pays weekly. These are both extreme rates, and GOOY's headline figure is slightly higher. But a headline yield is a snapshot, not a blood test for sustainability. It connects a recent distribution pace to a current share value. It does not guarantee that pace will continue, and it does not tell you what happened to the original capital while the checks were arriving. The distribution history changes the tone immediately. GOOW's first 4 distributions averaged 83 cents per share. Its latest 4 averaged 38 cents. The recent average is 46% of the opening average. That means the payout did not merely wiggle from week to week. The latest sample is less than half the first sample. GOOY's first 4 distributions averaged 36 cents per share. Its latest 4 averaged 8 cents. Its recent average is only 23% of the opening average. 8 cents per share is still cash, but it is a very different income experience from 36 cents per share. This is where headline yield can create a rearview mirror illusion. A quoted rate may look enormous, while the actual dollars and cents arriving per share have already stepped down. An investor cannot spend a percentage printed on a website. The spendable item is the distribution per share, and that amount can change. GOOW therefore wins the recent per share payout comparison, with a 38-cent latest 4 average versus GOOY's 8-cent average. It also retained a larger share of its initial payout level, 46% compared with 23%. That does not make GOOW's trend healthy. It makes its deterioration less severe than GOOY's. The reasons these streams can move are tied to their different machinery. GOOW's ability to distribute cash operates alongside a leveraged Alphabet exposure whose gains and losses can vary sharply from week to week. GOOY's option premium depends on the calls it sells, their terms, Alphabet's volatility, and what the stock does relative to the call's strike prices. Option premium can be rich in one environment and less helpful in another. Premium collected today can also be offset by lost upside or losses elsewhere in the strategy. Weekly frequency adds another psychological wrinkle. A payment every week feels active and productive. It creates the sensation of a tiny paycheck factory. But frequency and durability are separate questions. Splitting a changing stream into more envelopes does not stabilize the source. The cumulative cash totals show why these products can remain compelling even after reductions. GOOW has paid $28.23 per share since launch. GOOY has paid $16.48 per share since launch. Those are meaningful cash sums relative to their respective launch reference prices. Yet the cumulative amount is historical. It cannot promise the next payment, and it cannot tell us what remains invested underneath. For that, we need to move from the envelopes to the account value. Net asset value is the value of the fund's underlying assets and positions on a per-share basis. It is the capital base from which future results must be generated. A high distribution fund can send out substantial cash and still leave an investor worse off if that base deteriorates fast enough. GOOW began from a launch reference price of $50.98. Its latest NAV is $64.71, producing a 27% NAV return since inception. On the supplied endpoints, the capital base did not erode. It grew. That deserves real credit. GOOW distributed cash while finishing above its launch reference level. Its leverage structure clearly creates risk, but in the period supplied, the NAV path ended in positive territory. This is not a case where every dollar paid out simply showed up as a matching hole in the share value. GOOY presents the opposite picture. Its launch reference price was $20.51, and its latest NAV is $12.66. That is a 38% NAV decline since inception. The fund paid investors along the way, but the remaining per-share capital base became much smaller. This is the crucial difference between receiving income and preserving the machine that produces it. Imagine two orchards selling fruit. One distributes a large harvest and finishes with more productive land than it started with. The other distributes fruit while part of the orchard disappears. Both produce something valuable, but their capacity for the next harvest is not equally situated. GOOW's positive NAV result also fits its strategy's opportunity set. Amplified exposure can benefit strongly when the underlying stock's path is favorable. The same leverage can hurt in an unfavorable or choppy sequence, but this particular start-to-latest comparison ended above water. GOOY's synthetic covered call design faces a different structural challenge. Premium can support cash distributions, yet capped participation means the fund may fail to capture all of a powerful alphabet rally. During declines, premiums can soften losses but cannot erase them. A cycle of limited upside capture and substantial downside exposure can gradually pressure NAV, especially after fees and distributions. The direct head-to-head on capital preservation is therefore decisive. GOOW held up much better. Its NAV rose 27%, while GOOY's fell 38%. That does not prove GOOW will continue rising or that GOOY cannot recover. It tells us what each structure actually delivered over its own available history. Those histories are not identical in length either. GOOY launched in 2023, while GOOW launched in 2025. GOOY has traveled through a longer market journey. GOOW's record is newer, so its positive endpoint has had less time to encounter different alphabet and volatility regimes. Comparing the outcomes is useful, but treating the periods as a perfectly controlled laboratory experiment would overstate what the data can prove. NAV alone would unfairly ignore the entire reason these funds exist. They distribute cash. So now we reunite the payments with the capital path. GOOW's simple distribution inclusive return since launch is 82%. That combines its launch-to-latest value change with the cash it distributed, using the supplied simple methodology. It is a strong positive result. The investor was not merely compensated with checks, while the underlying position collapsed. Both parts of the ledger contributed positively. GOOW's simple distribution inclusive return is 42%. That is also positive, despite the severe damage visible in its share value. This is exactly why looking only at a price chart can misdiagnose an income fund. The cash distributions were substantial enough to produce a positive simple all-in result even though the NAV endpoint was much lower. GOOW leads the total result comparison by a wide margin, 82% versus 42%. But the more educational contrast is how each fund reached its number. GOOW arrived with a positive capital contribution plus cash distributions. GOOY arrived with cash distributions overcoming a negative capital contribution. One result resembles earning rent while the property appreciates. The other resembles collecting enough rent to remain ahead even though the property's value falls. Both can show a gain on paper, but the quality and repeatability of the journey are different. That word simple matters. This measure adds the supplied cash distributions to the supplied value change. It is not the same as a personalized investor return. Actual experience can differ based on purchase date, sale date, reinvestment, taxes, bid-ask spreads, brokerage handling, and the sequence of weekly payments. A person who entered after launch did not receive every distribution in this record. Someone who spent the payments had a different compounding path from someone who reinvested them. The comparison also exposes why distribution yield should never stand in for total return. GOOY has the higher headline yield, yet GOOW has the stronger supply distribution-inclusive result. The louder cash headline did not produce the better all-in outcome. For an income investor, this is the accounting question that matters. After counting both the cash sent out and the value still sitting in the fund, what was actually gained or lost? On that complete scoreboard, both funds remained positive, but GOOW produced the stronger outcome and did so with a healthier contribution from capital. A start point and an end point can hide the violence in between. Maximum drawdown measures the largest peak-to-trough decline observed during the period. It gives us a sense of how painful the worst stretch became before any recovery. GOOW's maximum drawdown was negative 31%. GOOY's was negative 46%. Both are severe. Neither belongs in the mental category of a calm cash substitute. A weekly payment landing in the account does not cancel the experience of watching the position lose a large portion of its value. GOOW's smaller drawdown means it held up better during its worst measured decline, but negative 31% still demonstrates what leveraged single-company exposure can do. The weekly reset can amplify unfavorable moves, and volatile back-and-forth trading can create path-dependent drag. Alphabet may be a major company, but concentrating a derivative strategy around one stock leaves the fund exposed to company news, advertising trends, artificial intelligence competition, regulation, valuation changes, and broad technology sentiment. GOOY's negative 46% drawdown is worse. Its written calls can collect premium, but those calls do not provide unlimited downside protection. When the underlying exposure falls, the premium is only a buffer. When the exposure later rebounds sharply, the calls can restrict participation in that rebound. That combination can make recovery difficult, absorb much of a decline, then surrender part of the snapback. The distribution trend adds a second layer of risk distinct from market drawdown. Both funds paid much less per share in their latest 4-payment sample than in their first 4. For someone depending on weekly cash flow, that is income sequence risk. The share value can fall at the same time the payment shrinks, creating pressure on both sides of the household ledger. GOOY shows the harsher combination in the supplied data, the deeper drawdown and the more severe payout contraction. GOOW's risk record is comparatively better, but better here means less damaged, not low risk. Its own drawdown remains substantial, and its recent payout average was still far below its opening average. Fund age complicates the comparison again. GOOW's shorter record has simply had fewer opportunities to encounter a full range of environments. A new strategy can look resilient because it is well designed, because the underlying environment was favorable, or because its hardest test has not happened yet. GOOY's longer record contains more evidence, but that evidence includes serious capital and distribution stress. Other practical risks sit outside these headline figures. Both funds charge expenses that must be overcome. Both depend on derivatives functioning as intended. Collateral, counterparty exposure, option execution, tracking differences, and tax treatment can affect what shareholders experience. The funds are also concentrated around the economic behavior of one underlying company rather than diversified across unrelated businesses. The clean risk comparison is this: GOOW took less peak-to-trough damage and retained more of its early distribution level. GOOY experienced the deeper decline and the steeper reduction in weekly cash per share. Neither has demonstrated a stable, low-volatility income stream. The deterministic assigned verdict for GOOW is on life support. The payout increasingly comes at the expense of capital or is being cut. That label may sound strange beside an 82% distribution-inclusive return and a 27% positive NAV return. GOOW's capital outcome was plainly strong, and it deserves praise for finishing above its launch reference value while making substantial distributions. But the diagnosis is driven by the condition of the payout engine as well as the all-in result. Its latest 4 distribution average is only 46% of its first 4 average. The patient made money, but the weekly pulse weakened sharply. The deterministic assigned verdict for GOOY is also on life support. The payout increasingly comes at the expense of capital or is being cut. Here the evidence is more alarming. GOOY produced a positive 42% distribution-inclusive return, so declaring the entire strategy dead would be inaccurate. The cash mattered, but the NAV fell 38%, and the latest 4 distribution average is only 23% of the first 4 average. The fund delivered enough historical cash to remain positive under the supplied simple calculation, while both its capital base and payment rate showed significant deterioration. The shared label should not flatten the contrast. GOOW is the stronger patient in this examination. Its all-in result was higher. Its NAV finished in positive territory, its maximum drawdown was less severe, and its recent distribution retained more of its opening level. GOOY's option income machine generated real cash, but it did so alongside deeper capital damage and a sharper reduction in the per-share payout. Still, these are different tools, and suitability depends on the goal. GOOW is a leveraged weekly alphabet vehicle with an active distribution policy. It may appeal to research focused on amplified participation, but that leverage brings path dependency and meaningful downside risk. GOOY is an explicit synthetic covered call vehicle. It exchanges some upside potential for option premium, which may suit research centered on current cash generation, but its record shows the danger of confusing premium collection with capital preservation. Neither verdict is a command to buy, sell, or hold. A strong historical result can reverse. A damaged strategy can improve. Distribution policies can change, option conditions can change, and Alphabet's future path will not copy its past. The final lesson is not that weekly income is fake. The cash was real. The lesson is that every payout has an economic source and a trade-off. Before admiring the yield, identify the machine, inspect what remains after the payments, and ask whether the income stream is strengthening or surviving on a weaker pulse. Different tools, different compromises, different evidence. Research only. 2 quick things before you go. If this head-to-head helped you cut through the hype, hit the like button and subscribe. It is what keeps these autopsies coming. And tell us in the comments, which of these 2 would you pick and what matchup should we run next? We read everyone. Thanks for watching.